VOO and VTI are two of the most popular ETFs in the market, where both of them provide a broad scope to the US economy, all within one purchase. But there are important differences between the two, so whether you're brand new or just not confident on how to approach them, this video is going to cover everything you need to know to go out and master your own portfolio, which that is a huge goal of mine when creating these videos. So if you do find value in this content, I'd really appreciate you hitting that like button and subscribing with notifications on for future content like this. So to get straight to it, here is a quick overview of VOO and VTI. For starters, understand that VOO and VTI are ETFs, so that means that you can trade them on nearly any investment platform that you decide to use. So let's just say you have a Fidelity account, you can invest into VOO or VTI, and that won't affect you at all. But if you look on Vanguard's page at an ETF like VOO, they have a direct link to their mutual fund version that is VFIAX, which also tracks the S&P 500, but because it's a mutual fund, it has a slightly different underlying structure. Because of that, trying to buy VFIAX on Fidelity would actually charge you a fee, and many other platforms won't even show the option. So if you are actually trading on Vanguard, you may be interested in getting their mutual fund version, VFIAX, or the total stock market version, that is VTSAX, but the key things to know about these is that Vanguard requires a minimum $3,000 to get started with them. But there is one nice perk about using them on their platform, and that is that you can set up automatic investments and withdrawals. But for most of you watching, ETFs are going to be the way to go. Now when it comes to VOO, this investment stands for the Vanguard S&P 500 ETF, where looking at the prospectus, it specifically states that this fund is designed to track the performance of the Standard & Poor's, the S&P 500 index, which this index is a recognized benchmark of the US stock market, where it is composed of 500 of the largest US-based companies. And if you didn't know, the Standard & Poor's company goes all the way back to the year 1860. But it's really important to understand that with these indexes, there are going to be strict rules on what companies are going to be able to be listed inside of the index or not. For example, with the S&P 500, it specifically states that currently the companies must be $18 billion or larger in market cap, which is pretty much the value of the company that is traded on the market. And once the companies are selected into the S&P 500, the index is going to rebalance quarterly in the months of March, June, September, and December, because the markets are always changing. One stock may be at the top right now, but in 10 or 20 years, the markets will rotate and there may be a different company at the top. Which, fun fact, the first date the S&P 500 index has data to was from 1928, where it was officially launched on the market in 1957, and crazy enough, even since 1928, it is reported to have an average annual return of roughly 10%. I'll keep the data short, but based off of that, if you were to invest $500 every month when you were 20, that means by 60, during this time of averaging 10% of a return, you would now have $2.6 million in the S&P 500. This makes index funds like these among the best investments that you can use to build wealth over time as the US economy develops, which it historically has always done. So for these indexes, specifically the S&P 500, be aware that companies in the index could also be delisted if they fail to meet the index's criteria, where some of the most common ones include a significant drop in the company's market value, liquidity issues such as insufficient trading volume, a poor financial performance, say a company is consistently having negative earnings, or they fail to meet legal requirements. On top of that, understand that VOO and VTI are market cap weighted, which means the companies that are inside of the funds are given weight based on their size. So in VOO, currently Apple, Nvidia, and Microsoft have among the largest impact in the fund, where if we take the top 10 companies and combine them, they contain roughly 35% of the entire fund, but more on that later. Whereas if we look at VTI, which is the Vanguard Total Stock Market ETF, this fund tracks the CRSP US Total Market Index, which represents approximately 100% of the investable US stock market, and includes large, mid, small, and micro-cap size companies, which contains nearly 4,000 companies in the fund. But this index is much newer, as it was created in April 2011, where it also rebalances the companies in the fund on a quarterly basis. And lastly, because both of these ETFs track an index, it means that they are passively managed, which makes them much cheaper to own, as their expense ratio for both of them is 0.03%, which is simply how much it's going to cost you per year to own the fund, and it's something that's going to automatically be taken out of the investment as you own it over time. It's not something you're going to have to pay separately. In fact, a simple example they have in their prospectus is that if you have $10,000, the first year you will pay $3 in fees. It's literally the price of a hamburger. And then assuming a 5% average return, which these funds have done much better historically, but that $10,000 would end up costing a total of $39 in fees after 10 years. It's extremely cheap compared to actively managed funds, robo-advisors, or financial advisors. So knowing that, here are the key differences that you need to know when analyzing the choice between VOO and VTI. So now that you know both of these ETFs track very strong indexes, the biggest difference here is that one of them tracks 500 of the largest companies in the US and sticks to only being large cap stocks, where the other one tracks pretty much majority of publicly traded companies in the US, where VTI currently has 3,644 holdings in the fund. Because of this difference, the top 10 holdings for VOO make up roughly 35%, where the top 10 for VTI make up roughly 30% of the fund. And as you can see within the individual companies, the difference comes from Apple having just over 7% to VOO, but then for VTI, it is just under 6% of the weight, where many of the ones following will be slightly lower for VTI because they have many more holdings. But not only are the company's weights going to be slightly different, it's because VTI contains roughly 89.66% of large cap stocks, 7.68% mid cap, 1.74% small cap, and 0.37% micro cap, where VOO is pretty much all large cap stocks. And then if we break down the sectors that make up each fund, you can see the largest ones are in technology, where for VOO, they're going to be slightly higher than VTI. But if you look closely, they are all very similar and mostly within a percentage of each other. From there, because they are so similar, if we look at the overlap between the two, 87% of VOO is calculated to be inside of VTI, which by the way, I'll leave that tool and all the other ones I've used in this video in the description below for you. And while you're at it, if you are interested to start investing on a new platform, I'll have a link in the description below to some of the top options that you may be interested in. But because of that huge overlap, if you were to purchase VTI, you are pretty much putting 87% of the investment into the S&P 500 VOO, and then the rest of that investment is going to be put into smaller companies that are not inside of the S&P 500. And then another fact to point out is that VOO will be slightly more focused on technology, where it has an estimated 2.2% more toward that sector, where VTI has 1.1% more weight to the industrial sector. Because of these differences, the historical performance between each is going to be slightly different, where over the past year, VOO grew 36.36% in value, where VTI grew 35.27%, which if we look over the past 3 years, the average annual return for VOO was roughly 11.9%, where VTI was 10.1%. To compare even further, the past 5-year average was 15.9% for VOO and 15.2% for VTI. And the one I like to view most is the long-term performance of 10 years, where VOO's average was 13.3% and VTI's was roughly 12.8%. But besides that, interestingly enough, VTI has actually computed a higher standard deviation at 15.75%, rather than VOO's at 15.3%. But from there, if we look at the Sharpe ratio, which indicates the actual return that you get along with the amount of risk that you are willing to take, for VOO, the number is higher at 0.76 compared to VTI at 0.71. And lastly, in case you didn't know, they both pay a dividend, where VOO currently has a 1.24% dividend yield that pays out quarterly, and VTI is extremely similar, but with a 1.27% dividend yield. Now altogether, the data is extremely similar, but here are the key things to consider for which one is right for you. Now, if you are one using an account like a 401k, where you are unable to buy a total stock market index fund, and let's say your only option is an S&P 500 index fund, I wouldn't worry about buying that because it is still one of the best investment options out there that you could purchase in the market. And if you're in this position and you want more diversification for your investments, you could consider purchasing other indexes in other accounts that you have to balance out your ideal portfolio goals. But for any investment accounts that you have complete control over, like an IRA or traditional brokerage account, even though the S&P 500 is among the best index fund, I'd still consider the overall diversification for your portfolio, which for this case, VTI would be the easiest way to create a foundation for your portfolio. In fact, there are many 3 or even 4 fund portfolios that utilize VTI rather than VOO just because of the simplicity alone. So to break it down from that aspect, if you are one looking for a simple approach to still optimize your diversification, VTI would be the way to go. But if you are one that's more hands-on and you like to see what sectors you are purchasing in and have more control over that and track how well each one of them is doing, you could purchase VOO as the large cap portion of your portfolio, and then consider a mid cap fund like Vanguard's VO, a small cap fund like Vanguard's VB, to fulfill your portfolio. Or if you really want to customize your portfolio and try different things out, you may want VOO for your large cap exposure, but maybe small and mid cap you want tailored toward growth, like Vanguard's small cap growth ETF with the ticker VBK. I like keeping things simple, and I think the overall diversification is a great approach whether you want to customize it or just go with VTI. I personally don't see a reason to purchase VOO and VTI, but I will say if you already owned VOO and now you want to purchase VTI, that could be a reason why you'd have both in the same portfolio, because I personally wouldn't recommend selling VOO just to switch over. Because of how similar they are, depending on your tax bracket, it may not be worth actually triggering the taxes. Realize that VOO and VTI are extremely similar. You can't go wrong with either. It comes down to what kind of exposure you want. But I will say, if you are one looking to be more on the aggressive side, adding a growth fund like VUG, SCHG, or QQQM could be a solid option to consider. Which, if you want to check it out, I created this entire video comparing the three, and I'll have other relevant videos similar to this that I created in the description below for you. Which, while you're at it, I'll also have a link to some of the top investing platforms in the market, which, depending on the one you choose, I may earn a commission for it, which is greatly appreciated. End of the day, I want you to do what's best for yourself, but because you've stayed this long into the video, I think you may find great value from some of my free learning guides I created, such as my Ultimate Index Fund cheat sheet that includes a ton of data comparing the best index funds I've analyzed, including the spreadsheet I used for this video. I highly recommend you check that out, which, if you want to see how I allocate each of my investments and other exclusive content, consider checking out the Patreon I have linked in the description below. And as always, don't forget to hit the like, subscribe, and notifications button for future content like this.